Hi, and welcome to my channel. For those of you new, my name is Dave, and I work in financial services. And these videos are a mixture and journey towards my financial freedom. They will cover financial products, and they will also cover financial well-being, so you, like me, can reach your aims sometime in the future. Now let's get into this latest video. Now, the news is full of bad news every day. The economy, shall we say, record inflation, so-called impending recession. But what should you do? Well, you should stay calm. Think long term. And the following is a few key points you may wish to consider. First of all, find your reason why. What are you investing for? Now, personal finance is personal to you. Ignore other people. Ignore the doubters, people who may discourage you. You may wish to tell your immediate family, close friends your plans, but only convey with people who will support and encourage you. Now, I personally enjoy investing, and my reason for investing is to retire early at the age of 55. I'm 51 now. I can retire at the moment if I wish, but I enjoy my current employment. My aim in future is to live off annual dividends and so-called passive income. Now, you may need to create some short, medium, long-term retirement goals. Get yourself some pen and paper or create a simple spreadsheet and set yourself some goals for the next 12 months, 3 years, 5 years, or even long term. Now, it may seem very daunting at first, but it'll be invaluable to you and it'll be a very rewarding exercise. Think of it as going on holiday. You buy yourself an airline ticket to travel somewhere, a so-called destination. You don't just turn up at the airport in hope. You have to have a journey and plans mapped out for you. So there's a great saying, you will be in the same position in 5 years' time unless you decide to take action. And that applies whether it's investing, personal finance, personal fitness. So first of all, find your reasons why you are investing. As we said at the start of the video, ignore the media. Unfortunately, bad news sells. They will tell you about the days when the market is down by a large fall or a percentage, or certain events are published, such as interest rate rises, increasing inflation. Every day the news is full of doom and gloom, such as the so-called cost of living crisis and impending recession. In 2020, when COVID first struck the markets, it reacted badly because they hate uncertainty. But if you had been brave enough to act during that period of market uncertainty, you would have made some very vast profits, some very great returns. Now, investing should be seen as safe, boring, steady. The S&P 500, the biggest stock market in the world, normally gives an annual return of around about 9% per annum. There will be good years, there will be bad years, so avoid the hype and short-term sentiment. And avoid the latest fads, get-rich-quick schemes. If everyone's talking about investing, ignore them. It will create a bubble. We've seen in the past a dot-com boom, shall we say. Okay, just as a simple example. If you're new to investing or experienced, create a portfolio of cheap ETFs against global markets and so-called multi-asset funds. There will be good performance, there will be bad performance, as each country will grow at different rates, but you can just switch off and ignore the market noise. You don't need the stress, you don't need the worry. Investing should be considered simple. And as your experience and confidence grows, then branch out to individual companies, different asset classes, different sectors of the economy. Okay, but ignore the media. Now, this video is going to be quite simple, shall we say, but I am going to include one chart. If we look at the following chart, it's the S&P 500 for the past 12 months. Now, for the year to date, we are down 15% since 2022. And obviously, recent events last week, announcements were made by the chairman of the Fed in the US, and the market reacted badly. They were down over 3% on Friday alone. but it's a great example. Don't look at stock prices at your portfolio every day. Switch off from the market. It will only drive you crazy, as the market will be up and down from one day to the next. Unless we're experiencing a bull market or a bear market where trends and patterns will occur and the market will go up and down on a regular basis for a few days. Learn to review your investments less frequency. Now, I personally record my assets at the end of the month to chart and record my net worth and for updates for YouTube videos. But it doesn't bother me in the slightest if my portfolios are up and down. I have long-term plans and goals, and I have no plans to sell any of my investments, as they're all considered long-term holdings. So my last 5 years I've recorded my videos, it's an average of 12% year on year. Okay, simple example, last year we were up 30%, this year we're down about 5%. We will have good years, we will have bad years, but I'm going to ignore short-term market sentiment. Now, it may well be once a year you review your annual assets. It may well be a New Year's resolution. It may well be the end of the tax year where you complete some kind of annual rebalancing or review, such as your asset values, the state of any liabilities, mortgage contributions, shall we say, your level of contributions, or you review your existing funds, such as your workplace pensions, you update your will, etc. Also, make sure you are reaching your targets or investment goals. Now, I personally set financial goals over the Christmas period when work is quiet, but I don't review them until the following Christmas. I know there will be good months, I know there will be bad months, good years and bad years, but I'm personally looking for an annual return of 10%, along with a specific amount of dividends paid out for each portfolio I own, and all dividends are automatically reinvested. So I'm going to ignore stock charts, I'm going to ignore prices, I'm going to enjoy or ignore bad news. There is nothing you can do, it is out of your control, but how do you react to that so-called news? If you're going to carry on investing to the market, simple thing you should do is automate your savings, create so-called investment habits. Now, learn to pay yourself first. It may well be the first of the month. It may well be payday through standard or direct debits. Learn to automate your savings. You will be surprised at what happens when your savings become a habit. You may not miss the money, but it's a great incentive, especially when you reach certain target levels, such as your assets, your investments growing on a compounding rate. Normal people spend first and then they invest what is left at the end of the month. Unfortunately, that is the complete way of creating a successful investing plan. So learn to pay yourself first. And the final point of note in this video is don't oversell your investments. Keep your costs to an absolute minimum and keep your assets in a self or a tax efficient vehicle away from the taxman. Set up a stocks and shares ISA. Set up a self-invest personal pension. For an annual ISA, you have an annual allowance of £20,000. Now, it may well be you are nowhere near that allowance. Most people won't be, but use that vehicle to get all your investments gains in future tax-free. And any dividends you receive will continue to grow tax-free for the foreseeable future within the tax-free wrapper. With regard to any investments I make them within an ISA and a SIP on a regular monthly basis. I buy on a set date each month, as my dealing costs are £1.50 per trade, irrespective of value. So the same price occurs whether I buy 100 shares or £100 of shares, or I buy £1,000 of shares or a fund, compared to a normal dealing cost of £9.99 plus stamp duty fees. It may well be you stick to cheap ETFs compared to paying excessive charges for actively managed funds, The vast majority of managers will fail to beat the market, will fail to beat a benchmark. So keep your fees and costs low. I also buy shares a long-term hold. The last time I sold a personal share was back in the summer of 2020, when I sold half on an existing holding within a UK FTSE 100 company as it had doubled in value and the company's fortunes had somewhat been hampered by the COVID shutdown. So I personally saw it as a great opportunity to release some profits, but also to diversify my portfolio as it was mainly UK based, and I then put that money into a global ETF. But it was the last time I sold a share was over 2 years ago. Do your background checks, do your due diligence, buy good companies at cheap prices and hold on to them for numerous years. It will pay off handsomely. Remember also, every time you buy and sell a share, it will create a loss. And a loss is only a loss on paper, is superficial. It will not look good, okay? But a loss will only become crystallized if you sell that particular investment. And remember, there will be costs. There will be costs to sell the share. There will be costs to then buy new or other shares or funds. Hopefully by adhering to these simple rules, it will give you greater confidence and reassurance during these times of uncertainty, which the vast majority of investors will never have experienced before. We've had a bull market for the last 10 years. 2022 has been somewhat sporadic, okay? But think long term. And above all, stay calm and find your reasons why you are investing in the first place. Remember, if you like the video, subscribe to the channel so it can grow and reach a wider audience, and we'll see you in the next video.